This is Prince Dykes. This is the Royal Financial Investment Group. Thank you guys for watching another quick video tutorial. If this is your first video, there are tons of videos that you can look and see what you like, all the other good stuff. Pretty much don't forget to hit the like button, subscribe button, comment button, share button, whatever button, all the other good stuff. Let me know how I'm doing. Hey, thumbs it up, thumbs down. Tell me how I can get better. So with all that being said, let's get straight into the video. So today's video is pretty much, well, tutorial. It's going to be, let's say, a situation where you have a stock and you want to sell a covered call. So let's go to, for example, I have the stock symbol PSEC pulled up. I'm going to type it in here so you can see PSEC, PSEC, just type it into the symbol. And it's going to pull up PSEC, for example. Right now the market is closed, so it's not real time. But I'll just give you an example of how you can, a little situation, how you can sell a covered call. So let's look at the chart here for PSEC, right? And let's say you're looking at PSEC, we're going to go back to the max. So this chart is giving me the max from, let's say essentially from 2005 to now of how the stock moved. Yeah, I have little different things. You can set your chart up however you want to set it up. But let's look at it this way, right? Let's say you say, hey, well, the highest PSEC this stock has ever traded was 1750, and ever since 2007 when all the stocks went down, it kind of touched about that 750 boundary, and it's been kind of bounced between 750 1250 range. 750 1250 range is like this tunnel that is moving in, and hey, I have this stock, I brought it at $12 and now it's sitting around $8. I'm losing value, thinking about getting rid of it. I don't like it. Whatever that being said, right? So one of the first things you can look at is when you look at a stock, let's say this stock here, this stock is paying 15% annually, right? Dividend. So I can't highlight it, mouse acting crazy, whatever, you guys get it, right? 15% that is paying you annually, right? It's paying you 11 cents monthly, 11 cents for every stock that you have. So you get 11 cents every stock. If you do the math, that's about 15% annually. I don't know if you noticed, but 15% annually on dividends, that's pretty doggone high. So when a stock is that damn high, it's not going to grow that fast because it's paying all this money back out to its shareholders, right? Because think about it. You can go over here, for example, I know I'm sliding on topic a little bit, but you guys are my fans. I do whatever for my fans. So let's say you go here, let's type in, we're going to go to, let's go to bankrate.com. We're going to go to bankrate.com, right? So you're going to go to bankrate.com. Bankrate.com pretty much gives you all the rates of banks, national, all the other good stuff, right? And we're going to use a search, for example. Where's this search at? Bank rates. Boom. We're going to look at current rates. Let's see what that one gives us. What we're looking for, let's say we're going to look at CDs. CDs play pretty good. Highest, let's see this. I'm going to click on highest national available. 1 year CD. The product, we're going to look at a 1 year CD, right? Because we just said that PSEC was paying about 15% annually. So as this come up, we're going to head back over to E-Trade before this one comes up. All right, it's back up now. It came back up quicker than I thought. So, oh, bam, look at this. What's that? Citibank? Well, what is this paying? 1.5% compounded daily, 1.4%, right? Look at this, 1%, 1.4. These give you the national highest results. Up here for a 1 year CD is 0.23 to 0.17. You see this, right? Y'all saw that 0.1 point whatever, right? My point is saying that, hey, you're getting 15 over here. So the national average at a bank, I don't know where you're going to get it from. So it's a good stock too if you want to preserve capital and you want to preserve capital and you want to collect the dividends and get it, create a little income flow. Those things are good. But a stock that plays a healthy dividend that's this high, it usually doesn't grow because it's taking that money and it's throwing it back out to its shareholders. Whereas in a growth stock, they keep that money and grow the company. So you say like, hey, I got the stock, I'm down in value, I want to make a little bit of money off of it. Every time it gets up to $12, I don't think it's going to go anywhere. So let's look at the options trade, you know, the options chain. So close that out, done with that. So this is January 17th. That's a little too close. But let's say you're saying, let's go down to August, for example. We're going to strike this out. We're going to go to 11. So, well, that's not that many in there. So let's say you're seeing here, this is saying, hey, if you own the stock, with pretty much somebody's paying 100, we're saying 1.15. That's they're paying $1.15 per share if you want to sell the stock, right? Let's say a covered call. So let's say you, for example, you say, hey, I want to sell a covered call because this stock here is not going to go over $12, right? This stock is not going to go over $12.50. So what you do, for example, is let's go up to the trade, how, you know, and we're going to go to basic trade, and we went to basic, right? My bad, I went to the wrong thing. Yo, I'm in the right one. Option basics. So trade option basic. So we're going to type in the word PSEC. Boom. Go. And then you're going to sell to open. Now it depends on how many contracts, how many stocks you have. If you have one contract is 100 shares. Let's say if you got 300 shares. Boom, that's 3 contracts, right? What do you want to do? You want to put a call over it. Because what this is going to do is okay, we're going to finish this up. And let's say August 21st is expiration date. And you say, hey, it's not going to go over $12.50 or whatever, right? And you know, you can, let's say you want to go at market, for example. So what I have locked in here, what this is going to tell me, is going to say if your stock, you got a strike price of $12.50 until August 21st. Until August 21st, if PSEC, if this particular stock goes over $12.50, $13, say the stock goes up to $20, you're going to run the possibility of somebody can call your stock for $12.50, right? So this stock goes up from now until March, not March, but from now until August. If this stock goes to $12.50, somebody can call, they can buy your stock from you for $12.50, and you can lose your stock for $12.50, right? You're saying, well, I don't want to lose my stock, but this is the way that you can make out. If you buy a call option, the best thing that can happen to you is that you sell it for, right now you have market. You got to look at the bid, you got to look at the ask. So let's say you put in a limit. You can put in a limit order. A limit order is not guaranteed to be filled, but you can put it in. Let's say you put it in for $1. That's $1 for every share. That's $100 per contract. So you're saying, hey, I'm going to sell this option for $300. And what this does, if somebody buys it, if the stock doesn't go to $12.50 or past $12.50, you pretty much just made $300. Because remember, you sold this for $300, right? You sold a call. It's called a covered call because you already have the stock. You sold a call. Somebody else brought it. They're going to give you $300. You have their $300. Now, if the stock goes up to $20, you have to sell your stock for $12.50. That's strike price. But if the stock just sits at $8, $9, $10, it's a strong possibility that somebody's not going to go call your options. Because why would we call that exercise the option. Why would I exercise the option if on the market is $10? Why would I buy it from you for $12.50? Not smart, right? So most people won't exercise, which means you made $300. It's a way to make money if you if a stock is not moving and you want to make some money off of it, you're down a little bit in value, you want to recoup some of that value, this is a way you can do it. And all you got to do is here, hit the preview button, and it goes through. Here, price type, if you go in at market, right now the market, the bid is 0, the ask is 20 cents. The asking 20 cents per share, which is $20 per contract. But you can ask for whatever you want to ask for, or you can go in at market, just like when you buy a stock, right? You can set your limit on how you want to sell it. That's what it's selling for right now. The market is not open right now, so it's not really being retail. So that's the way that you can sell a covered call on E-Trade and make money from a stock that's this is a covered call. I haven't got into the opposite way of puts, all the good stuff. We're going to keep it simple. We're going to keep the video too long. Hope I didn't bore you out. Hope I didn't tire you out. You know, like, comment, subscribe, all the other good stuff I always say at the end of my videos. Thank you guys for watching. Peace.